Good morning.
We are online.
Good morning and good evening to all our presentators, our professors. Our afternoon program session. The title is the banking systems. We have for our professor Stefano. We have Raymond and Nat Bardawaj, and we have Professor Mahmoud, and we have Danilo. So, as a chairman of this session is Professor Mahmoud. So, I will give the speech to our professor Mahmoud, and have the speech there.
So thank you, Mr. Hassan. So welcome all to this special session on banking systems on International Symposium on Economic Thought. We will have 5 presentations, but we have 90 minutes. So each presentation around 15 minutes plus questions. And we will start with Mr. Stefano Siviero from Bank of Italy. He has a long and experience in economic modeling. He has published and produced various outputs about how to model economics. And today he will be talking about climate change. So we will start with Mr. Siviero.
Okay, so let me share my screen. Okay, I assume you can see my screen. And well, first of all, thanks a lot for having me here today. It's always a great pleasure to be in Turkey, even only electronically in Turkey this time around, but still, as they say, is better than nothing. Today I'd be talking, as you said, about climate change and central banks. In principle, the people don't think the central banks have much to do with climate change and can do much against climate change. But I'll try to show you that indeed central banks are actually quite active. They are doing something, and they must do something, and they are doing something. So let me get into my presentation. Well, first of all, of course, being a central banker, I have to show you the usual disclaimer. Whatever I'm going to say is just my opinions and not the Bank of Italy's. My presentation is made of 3 parts. First of all, very briefly, some evidence that climate change is going on and it is man-induced. I won't say much about this because I'm not an environmental scientist. Then I will discuss on why central banks should care. What are the reasons why central banks should monitor climate change? And basically, there are 2 kind of risks that the typical central bank is interested about: the macroeconomic risk and financial stability risk, and several both physical and transition factors that can impact those risks. And finally, I will, as I said, I will discuss what central banks are doing. Obviously, we are not in the front line. In the front line should be environmental agencies and that other actors. But actually, central banks are already doing something, and more is to come, I guess. So first of all, climate change. I took this slide from a website and shows the change in temperature in the last 170 years. And there is no question whatsoever, I guess, that in the last few years you had a sudden and very rapid increase in temperatures. You have all these red lines there. Something needs to be done. A lot needs to be done, as we will see in the one before the last bullet point. But even if we start doing something right away, we cannot avoid the consequences of what of what mankind did in the last decades, because emissions are very persistent. So even if we start acting very seriously today, which is not totally plausible, emissions in the past will still have an impact. Finally, politicians are moving. 1/3 of the funds in the next generation EU recovery funds should go for initiatives to combat climate change. Of course, it's a typical problem, a typical tragedy of the commons. Everybody underestimates the negative impact of his own or her own behavior. So on aggregate, the result is suboptimal, the typical problem of public goods. But this is not only individuals, but also countries that determine suboptimal outcomes. Just to give you an idea of how challenging this is, with COVID-19, emissions worldwide were 8% lower than normal. Now, 8% less than normal is what we need in the next century to reach the Paris Agreement targets. So, basically, if we need to reach the climate change targets, we ourselves, we meaning mankind, ourselves set a few years back, we will need a COVID pandemic every single year, or we should find a way to behave as if there is a pandemic every year. There are two types of risks or consequences or costs of climate change. First, there is a physical cost, for instance, due to extreme weather events. And here, you don't need to distinguish between the blue and the green lines. Just take the total. There is no question, there are up and downs, of course, but there is no question that in the last 40 years or so, there has been quite a trend upwards. Clearly, the cost, the physical cost from extreme weather events are rising. And then there are transition costs. The transition costs arise because if we want to combat climate change, of course, some sectors will need to be penalized, some other sectors we need to encourage, and of course, that will introduce a lot of heterogeneous impact across sectors and across territories. Some regions in the same country will benefit, some other will bear cost. And of course, economic policy must get ready to tackle this kind of cost. Why do central banks care? Central banks care, first of all, because these events will have these risks, both physical and transition, will have an impact on GDP, output gap, and therefore prices. And so whatever has to do with prices, of course, is the realm of central banks. Central banks must do something. It is not a priori clear what we need to do, because it depends on whether demand or supply factors will prevail, but clearly we have to keep an eye on the phenomenon. The other reason is financial stability, or more generally, even bank supervision. So the stability of the financial system as a whole. I mentioned earlier transition costs. They can have an impact on financial evaluations. The stocks, for instance, of firms that are environmental friendly will go up, but the stocks of firms, say carbon extraction, will go down. And central banks, not always, but typically, are also prudential supervisors. And therefore, we must monitor the amount of climate-related risk that is in the portfolio of banks. And at the same time, the financial sector is an opportunity to combat climate change because the financial sector, of course, is the medium through which financial resources are channeled to this or that production sector. And if we are able to channel financial resources in the good, quote unquote, direction, of course, that will help. I'll come back to that later and what central banks are doing. Climate risks, another reason to be concerned is, of course, the climate risks are possibly, most likely, mispriced. First of all, there is not a transparent information on the amount of climate risk that each firm is taking. There are the externalities I mentioned earlier. Everybody underestimates the global consequences. And then climate change is a very extreme event. And we know from the experience of COVID-19, unfortunately, that extreme events can be extremely more extreme, if you pass this expression, than we imagine. I mean, personally, I would never have imagined anything like the pandemic, and the consequences are gigantic. It is probably better to look at the stock market rather than banks when it comes to financing the green economy, because the stock market, by its very constitution, is more long-term projected. So the stock market is more interested than banks in the long term, and is more interested in financing high capital activities and high risk activities. Central banks, and here I come to the last part of my presentation. What can central banks do, and what they're doing already? We can lead by example. But before I go into our specific role, let me mention, what's happening in the financial market in general. ESG, S and G stand for environmental, social, and governance. ESG profiles are becoming more and more fashionable nowadays, and the issuance of, if you look at the right side picture, the issuance of green bond or ESG bonds in 2015 was very small, and now in 2020 will be about 10 times, almost 10 times as large. And ESG care about environment, human rights, consumer rights, and diversity. It's not easy to do, but I'll come back to why it's not easy to do. But issuance of bonds that care about these profiles is growing, and the central banks are leading by example in buying ESG bonds in their portfolio. Of course, not in the monetary policy portfolio, because the monetary policy portfolio responds to a different target. They're there, to combat inflation. But in our own investment portfolio, we can do something, and we are including more and more green bonds or ESG bonds in our investment. This, you can think, is a soft approach. It's a sort of gentle nudge that we are giving to the private sector as to what everybody can do to help a more environmental friendly economy. Central banks have created a network for greening the financial system 3 years back, and there are about 75 central banks. I just checked the Cumhuriyet, the TMC, Türkiye Cumhuriyet Merkez Bankası is not one of them. unfortunately, but maybe in the future the Turkish central bank will also join. There is a challenge, which is to preserve neutrality and diversification. And what do I mean by that? No, we cannot only invest in bonds that come from green firms. We have to keep a diversified portfolio. So we have to preserve some diversification. We also need to preserve neutrality. We cannot focus all our purchases in one sector and favor this sector against another. I mean, we are a public institution, all central banks are, and we cannot favor one private sector against another one. But we are trying to introduce also ESG criteria together with diversification and neutrality. And as the second bullet point shows, we have been quite successful. The carbon footprint of our investment dropped by 30% between 2018 and 2019. So, you know, we are quite serious about it, and we are expanding our ESG-friendly operations. Why is it so difficult? There are a number of reasons. First of all, as I mentioned, diversification and neutrality. Another difficulty is the fact, I still have 1 minute, is the fact that, as you see from the bottom charts, here is the correlation between 3 agencies that provide ESG scores. The correlation between these 3 agencies are very, very, very low, between 0.4 and 0.6. Or even 0.3, sorry, 0.6. So there are low correlations, and that depends on the fact that every agency relies on different indicators, and they give different weight to different indicators. Some agencies also take into account the future plans. Some other agencies assign ESG score to a firm only based on current plans. So, you know, there is a problem there. Partly, the ESG information is based on voluntary disclosure by firms only, so you know you can have doubts about the reliability. So, but I think that as the market moves in that direction, probably these differences will decline. And finally, and just 30 seconds and I'm done. As I mentioned, we are not on the forefront, but we can do a lot. And 2 members of the Eurosystem, so the member of the ECB executive board, Isabel Schnabel, and the president of the Bundesbank, Jens Weidmann, both flagged the possibility of taking a more decisive stance against climate change, and they suggested that the ECB could possibly, you know, discriminate among different collateral on the basis of how environmental friendly they are. So, you know, at the limit, you could accept only collateral which is environmental friendly, or as Isabel Schnabel said, you could have larger haircuts for bonds which do not belong to environmental friendly firms. Of course, if that is done, is big. No, I'm not sure this will be done, but I mean, it's a brave statement, because if that is done, there would be a big incentive for banks to prefer ESG compatible collateral rather than anything else. And sorry, I took a minute longer than I should have, but with this I'm done. Thank you.
Mr. Severo, thank you very much for this is a very emerging topic, and it is good to see that central banks are thinking about that. I have 2 questions, if possible. The first thing, as you summarized, climate change is a very low frequency issue, right? It takes longer time to see the effects, while central banks are more interested in the conjuncture. but somehow we can think climate change as negative supply shock. And actually they may be in the policy function in that respect. And what do you think about the effect of climate change on the output of the real interest rate? So the real interest rates are declining, and say the investment increases for climate change, or we do not respond now, and the future is riskier. So the two questions: what do you say considering climate change as negative supply shock? And second, the effect of climate change on the real interest rate, which were on a declining path, and output. That will clarify the concept for central bankers, maybe. Thank you.
Thank you for your questions. Very good questions, because they're very challenging, so they must be good. Well, there will be a negative supply shock for sure. At the same time, there will be a negative, well, for sure. I mean, if climate change reduces certain kinds of output, makes some part of the world unfit for production and possibly even living and so on, there will be a supply impact. There will be also demand impact, so I'm not sure which one will prevail, and that's of course challenging. But central banks, of course, they follow short-term developments, but they're also very interested in long-term. I mean, we are the typical central banker has a zero discount rate. We care, and that's why we're here, because we care about future inflation as much as we care about current inflation, and that's why we are also looking into this very long-term phenomena. On the impact on the real interest rate, and again, I'm not sure, but to the extent that a lot of investment, as you said correctly, of course, real interest rates have come down everywhere in the last 20 or 30 years. And they're, according to most estimates in Europe and US, they're close to the equilibrium. Long-term interest rates are close to zero. That, of course, is due to imbalance between a lot of saving and much less investment. But to the extent that the climate change, fighting climate change will require a lot of investment in green technologies, etc., maybe that will help. That will be, the plus side of climate change, if you like, that will help rebalancing investment and saving, and therefore alleviate the pressure, the downward pressure on interest rates. But of course, those are all things that are very hard to assess from today's standpoint. But thanks for the questions again.
Thank you very much. As you said, like, we have this decreasing interest rates, and say there is an investment boom due to climate change or addressing it. That will help. But as you said, central banks are interested in potential output, and if this is related to the future, this is now in our this question list. Thank you very much for this very interesting and for this very timely presentation.
Thank you. Thank you.
And the next talk will be from Argentina, Mr. David Feldman. His topic will be about the current banking system in Argentina, and his title is Institutional and Macroeconomic Factors Behind the Current Structure of the Argentine Banking System. The floor is yours, Mr. Feldman.
Thank you very much. Let me share my screen. Okay, first of all, let me thank the organizers of the symposium, especially SEMA, for the invitation to be part of the scientific committee and then to present about the Argentine banking system. I will essentially organize my presentation in four subsections. First, I will give a brief characterization of the Argentine banking system, but in order not to simply show some figures and tables, I will try to focus on the implications of changes in the regulatory framework and also in the macroeconomic performance of the country in shaping the current the current stance of the banking system. Essentially, when we analyze the Argentine banking system, we find a sector that is solvent and highly liquid, but at the same time it is very small, concentrated, and essentially focused on transactionary operations. Just for you to have an idea, there are 78 financial institutions regulated by the central bank, of which 13 are state-owned banks, 51 are private banks, among which we have about 12 branches or subsidiaries of foreign banks, and then 14 non-bank financial institutions, which are very small institutions. But essentially, the 10 largest banks of the country concentrate almost 80% of total deposits and more than 70% of loans to the private sector. So it is a relatively concentrated banking system. In terms of penetration in the country, there is a low physical penetration in the territory, since more than 50% of bank branches are located in the metropolitan area of Buenos Aires, which has about 40% of total population of the country. So the first feature I mentioned, the Argentine banking system is very small. We have here the evolution or the recent evolution of the credit to private sector in terms of GDP. And as you can see, in the last decade, we have a credit to the private sector is about, or it's below 14% of GDP. And it also exhibits a very pro-cyclical behavior. So in years of recession, then I will show some numbers about output volatility in Argentina. We see how the credit to private sector also has a decreasing trend, which goes in line with the recession that the country has experienced since 2018. These low levels of intermediation are not only low in historical terms, but also when we compare the banking sector in Argentina with other emerging market economies or, of course, developed economies. Here you have the comparison with other Latin American countries. As I said, credit represents about 12% of GDP. And the average for other emerging economies is 66% of GDP. And in the region, we have Chile, for instance, with almost 85% of GDP of credit to the private sector. And Argentina is, of course, on the bottom of this list. In the case of developed economies, the size of the banking sector is much bigger. And also, if we check the other side of the banking sector balance sheet in terms of private sector deposits, we see again that in the case of Argentina, we're at the bottom in the list of Latin American countries with a private sector deposit that represent less than or about 22% of GDP. When we check how households and firms finance their expenditures, this is what we have here in these two figures. On the left, household broad financing, and we find that the credit to firms by banks is lower than 6% of GDP. Just to have an idea, private consumption in Argentina represents about 60% of GDP. So this again shows the very low levels of intermediation when we analyze the case of households. With firms, happens something relatively similar. Companies obtain financing from banks that represent less than 6% of GDP. And also the domestic capital market in Argentina is very small. The financing through corporate bonds in the local market represent less than 1% of GDP. And then external financing, both in terms of bonds and loans, represent about 5% of GDP. Again, in the case of private investment represents about between 15 and 20% of GDP. So again, we find that firms finance their investment plans by internal funds or through other channels beyond the banking sector. What about the balance sheet of the composition of the balance sheet of central banks in terms of funding and assets? We find that there's a high proportion of assets allocated to short-term instruments. When we check the asset composition, we find essentially that for instance, liquid assets in domestic currency and liquid assets in US dollars, or central bank securities, which are very short-term instruments. So these are also very liquid assets, represent a very large proportion of the banking sector assets. The credit to the private sector represent less than 30% of the assets of the banking sector. And in part, this structure of this composition of the asset side of the balance sheet reflects what is happening in the other side of the balance sheet in terms of the funding composition. Essentially, banks' funding has a very short maturity. In Argentina, half of the deposits are sight deposits. The other half are time deposits, but the average maturity of time deposit is about 1 month. So of course, banks cannot take so much risk and finance very long investments when their funding composition is very short-lived. One feature that has implied certain problems in particular moments in Argentina in our history is the public sector exposure. There was a very traumatic experience in the end of the 1990s. Maybe some of you remember the collapse of the convertibility system in Argentina, which was a very strong currency board that the country adopted during most of the 1990s. By the end of this period, there was a large exposure to the public sector by banks, which ended. So when the Treasury faced a debt crisis, this translated into a banking crisis. But then we see that in the last 2 decades, especially because of the regulatory framework, the exposure to the public sector has remained in a very low level. It represents less or about 10% of total assets. When we compare this exposure to other Latin American countries, again, we find Argentina, when we look at the public exposure in gross terms, we are like in the middle of the table of Latin American countries. But once we discount the deposits from the public sector, which is this last column, we see that the net exposure to the public sector is one of the lowest in the region. I mentioned in the beginning of my presentation that the Argentine financial system is highly solvent, which in terms of regulatory capital compliance, that Argentina has a very high level of regulatory capital compared to the average the global financial system and compared to other countries in the region. Also, in terms of other relevant ratios of the Basel III regulatory framework, the Basel III pillars, in terms of liquidity coverage ratio, net stable funding ratio, and leverage ratio, in general, Argentina exhibits very good figures. So up to now, I show some numbers just for you to have an idea of the main characteristics of the banking sector in Argentina, but I will try to connect the current shape with some relevant developments in terms of regulation and in terms of the macroeconomic performance of the country. What I show here is a timeline in which we can find the main organic law reforms that were introduced in the country throughout the 20th century. The Central Bank of Argentina was created in 1935, and the first organic law emphasized price stability as primary goal. This was the mandate of most central banks by that time. Then in 1946, we find the first reform of the organic law that included high levels of economic activity and employment as policy objectives. So this was a very Keynesian mandate for the central bank. We find then, I will not focus in every of these reforms. I will just mention that a very relevant moment in time is 1976, when within the context of a military dictatorship that took power, there was a very important financial reform, and the new law of financial entities promoted financial deregulation in the country, and the new regulatory framework led to a concentration and transnationalization of the banking sector. Then, as I mentioned before, in 1991, the government introduced the convertibility law, which was a very strong currency board. And in terms of the mandate of the central bank, it adopted price stability as the exclusive aim of monetary policy. Then in 2001, 2002, there was a collapse of this system, the deepest macroeconomic crisis of the country in its history. And in 2012, there is the most recent reform of the organic law of the central bank, which again moved towards a dual mandate, in which not only price stability but also economic development with social equity was included as primary goal. So this is just to show that there's recurrent changes of central bank goals that reflected the political pendulum in the country and that have several impacts on how the financial system evolved throughout these decades. In particular, the law of financial entities of 1977 is a very important focal point, because it promoted within an environment of financial deregulation and reduced state intervention, had the premise of that markets could allocate resources efficiently when competition is ensured. Before this law, the Argentine financial system had specialized actors which were treated differently by financial regulation. There were development banks, there were small financial cooperatives that were very well distributed across the country and that were very close to small and medium-sized enterprises, and there were mortgage banks. But this scheme was replaced by the figure of universal banking with this new law. And universal banking implied that any financial institution, any commercial bank, was treated in equal terms for the financial regulation, and that any bank could do almost everything, unless what was particularly prohibited by this law. So this new scheme, this new model of universal banking that started in the end of the 1970s, promoted market concentration and also conditions that favor shadow banking, because some of these special figures of the previous financial framework, like the financial cooperatives, moved to outside the umbrella of the regulation of the central bank, and then they became new actors that continue with their activities but outside the regulation of the central bank. And also, as I said, foreign capitals entered also the banking industry. So just to finish my presentation in terms of the macroeconomic factors, one of the main features of Argentina is the macroeconomic instability. In terms of output volatility, we have here the evolution of GDP in real terms since the 1940s to the date. And in gray, we find the periods of the years of recession. So we see several recessions, some of them very deep. This is the crisis of the convertibility system, which is, as I said, the deepest recession experienced by the country before the COVID-19 pandemic. Up until the mid-1970s, the kind of business cycle that Argentina faced is what the Latin American structuralist literature denominates stop-and-go cycles, which are mainly driven by the external sector, by the balance of payment crisis. And from the mid-1970s onwards, following the financial deregulation and the financial integration of the country to the global financial markets, we find financial cycles and debt crisis, which are essentially what drives the business cycle in the last 3 or 4 decades. Of course, not only upward volatility, but also very high and stable inflation. In Argentina, inflation accelerations are mainly driven by currency depreciations. As I said, external constraint is frequently binding, and the persistency of inflation is due to the strong distributed conflict that is also a feature of the country. There are very strong labor unions that tends to resist any decrease of their real wages. So as we see here, the country has faced periods of very high and stable inflation from the mid-1940s onwards. We have in the 1980s the hyperinflation episodes. This is the time of the currency board, which is the 1990s, a period of very stable inflation. And then in the last 2 decades, we see a period of increasing but stable inflation. Just to show you that in terms of the balance of payment, which is behind many of these macroeconomic volatility. And just to conclude my presentation, let me emphasize that macroeconomic instability is what has pushed disintermediation. That's why we see a very small banking sector. And this instability has led Argentinians to save mostly in US dollars and outside banks. So that's from the funding side of the banking sector balance sheet, the reasons why we cannot see a banking sector with explaining a higher proportion of household and firms finance in the country. The planning horizon is shortened. As I said, the average maturity of time deposit is just 1 month. This leads to a very high liquidity preference by banks and the lack of long-term credit in the country. The long-term funding in the country can only be obtained by US dollars and mostly abroad. So this has very deep implications for private and public external debt dynamics. We have just came from a restructuring of the public debt, and we had to restructure the public debt with the IMF. And essentially, this is the other side of the fact that the financial system in Argentina is very small. And of course, the regulatory framework matters. The typical financial actors of a development process, as I mentioned, development banks or specialized banking like mortgage banking, are very difficult to find within a universal banking model like the one Argentina exhibits. Thank you very much.
Mr. Feldman, thank you very much for this very informative presentation. If you have a couple of minutes, I want to ask some questions. So my first question is, do you have any estimation about the wealth outside of the banking system? So you mentioned in your last slide that people usually save in dollars and outside the banking system. Do you have an estimate for that? Second, the credit to GDP ratio is quite low. How does that affect monetary policy transmission mechanism? So if central bank raises interest rates, then the effect on credit market will, as far as I understand, will be low because firms and households do not use that much. So what is the main monetary policy transmission mechanism? And finally, so GDP was very stable after 2010, while there was all this quantitative easing across the world. And you said the growth is sensitive to outside external funding. Somehow it seems that while after this global financial crisis, which I will be talking, there was excess liquidity that doesn't translate to system. That's just a side question, but I'm really curious about the monetary policy transmission mechanism, key mechanism, estimation about the wealth outside system, because I think Argentina has something around 17% investment rate. So investment to GDP is around 17%, and the credit to GDP is 10%. That means that somehow that investment is financed outside of the credit. And finally, you said that exposure of the public sector, banks to public sector decreased a lot. but the budget deficit in public continues, right? So then how does the public finance itself? Thank you again for this very informative presentation.
Okay, Mahmoud, thank you very much for your question. There were several questions, so in case I don't cover some of them, please, I will be asking you for help to remind me. The first you said estimations about the savings outside the banking system. That, you know, there are some estimated numbers from the balance of payments and the savings in dollars outside banks by residents represent like 4 times the international reserves of the central bank. I mean, that's huge. That's a lot. Of course, this is the result of several years of balance of payment surplus that were translated into formation of foreign assets by the Argentinians, and for some years this could have been reflected in an increase of deposits in the banking system in US dollars. But then after each financial crisis or balance of payment crisis, when the uncertainty goes up, then the Argentinians run to the banks and take their deposits outside them. And this is why we find these very huge numbers. I think that after Russia, we are the second country outside the US that holds US dollar banknotes. I mean, we can see that from the importation of physical dollars to the country every year. Then in terms of the transmission channels of monetary policy, as you say, considering that the credit to the private sector is very small in terms of GDP, the transmission channel from the policy rate to the structure of market interest rates and to the credit conditions is not very strong. Essentially, if I can share again my screen, I will use a graph a figure to show essentially the transmission channel, which is this one. Okay. Banks essentially hold a very large number of central bank securities. So the policy rate in Argentina is the interest rate on central bank securities, and essentially by adjusting this rate, the opportunity cost of banks adjusts, and therefore this interest rate translates especially to deposit interest rates, which are very relevant in Argentina for the arbitrage that investors and that savers take into account when they decide whether to save in Argentinian pesos and in the banking sector, or in US dollars and outside the banking system. So essentially, this is the transmission channel to the operate through the passive interest rates and not through the active interest rates. That was for your second question. Then, in terms of the global financial crisis and the global financial conditions within the quantitative easing period, essentially Argentina, after the collapse of the convertibility system and the default of the public debt, managed to restructure the public debt, but that was in 2005. But then there was a remaining of the bondholders which did not enter into the restructuring process. So we faced several problems with the vulture funds, and this led to several years in which Argentina did not enter into the international debt markets. And given that in that period, the country enjoyed very favorable terms of trade and therefore a current account surplus, there was not a very large need of using the financial account of the balance of payments in order to equilibrate the external sector. Of course, this changed after 2012, and that's why the country faced some macroeconomic instability in the last decade. But what I would say is that the country did not participate of this period of very favorable financial conditions abroad, and this is something that happened in 2016 when the country finally paid to the voucher funds and then got access to the debt markets and enter in a period of increasing public debt that lasted 2 years and which ended with a new public debt crisis. As you said, in terms of how firms finance investment is between 15 and 20% of GDP, as you mentioned, but credit to the private sector is lower than, or is about 10%. So firms finance some of their investment expenditure through retained earnings, and this has an implication on the pricing policy of firms, which need to raise funds in order to purchase their machineries and other capital assets. And as I said, the shadow banking may explain some of the investment expenditure, especially in the case of small and medium-sized enterprises. Finally, in terms of the exposure to the public sector by banks, as you said, the financial system is not very exposure to the public sector. When the treasury faces a fiscal deficit, as it happened in the several years, either the central bank has provided finance to the treasury according to certain limits that are in the organic law of the central bank, or it has issued debt in foreign currency in the international markets. So that's the way the central bank, the treasury has financed fiscal deficit in the last 2 decades. I think I cover all the points.
Mr. Feldman, thank you very much for this very clear and explicit answers. I personally learned a lot about Argentina banking system, and thank you again for your participation to ISET conference. And now, we start with Mr. Severo, an emerging question, climate change and central banks. We move to a macro issue, if you will, about the bank system in Argentina. Now we have a very different topic from India, Ms. Nav Bhardwaj. He will be presenting growth versus value investing in emerging markets like India. The floor is yours, Mr.
Thank you.
Bhardwaj.
Thank you, Mamu. Thank you for introducing me and for hosting such a lovely conference. I hope you all are safe and sound during these troubled times. Let me share my screen. And just a minute. I hope the screen is visible to all and I'm audible.
Yes, we can see the screen and hear you.
Great. Thank you for hosting us. To begin with, I'm a research analyst at one of the leading stockbroking firms in India, and would be presenting upon the value and growth investing. The phase being that no matter how hard we try to bring about change, it is only the investors which bring about where the capital flows are going to be, and the change usually tend to be in line with the capital flows in any emerging country. The way I've structured my presentation, we'd be focusing on how do we see growth and value in the country. The system of the Indian banking space, and and salient features around it as space in the current times. Talk about growth and value investing is that in value investing, the prices of the products that in the securities in the market are usually lower priced than the broader markets. The idea behind value investing is that stocks of good companies tend to bounce back after some time. Yet, if one tries to see this outside academia, the results that we see are much different. Also, what we tend to see is that the price many believe is that is below similar companies in the same industry. Yet, when one sees this with the light of the growth that they're offering currently, it again tends to differ from what the academia tends to suggest. They also believe that value stocks usually carry somewhat less risk than the broader markets, and usually when one invests, it takes some time to turn around and are called to be more suitable to long-term investors. In terms of, if we try to pitch this against growth, we tend to see that they are mostly higher priced than the broader markets. They tend to show a higher earning growth records and tend to be more volatile as compared to the broader markets. If you try to compare the two as to how they have been giving returns across the spectrum in India, we see that over a span from 1990, we see over 30 years, there has not been much of a differential when it comes to segregating value and growth stocks, because India has been one of the marquee emerging economies. And while deep discount stocks was something that many of the FIs would hunt for, it was rarely available. And from the basket of stocks that, what we have is that we see that financials tend to have around 35% of the total index. Now, like most other investing in most of the open-ended funds globally, funds tend to be benchmarked, and it's rare that one is usually deviates. The fund manager usually deviates from the sectoral allocation of the benchmarked index. Nifty, our major index, carries a weight of 35% for financials, and in that the private sector banks rule the roost and have a major contribution. So there are steady flows from index-related funds as well as other benchmarked indices-based funds in the country. As a result of which, if one tends to see the flows that come into these stocks, they tend to be pretty robust and continue to be, to find investment going ahead. If we try to see how is the banking sector, how is it split around in the country, we have around 12 public sector banks, private sector banks around 22 of them, foreign banks 46, regional rural banks usually they cater to rural population of 56 in number. Urban cooperative banks and rural cooperative banks are multitude in number, but usually have very, very small number of branches and public outreach, as well as in terms of the asset base that they carry, and just tend to remain statistic over here. If we try to see the market cap that these enjoy and the kind of sales, trying to compare the top 10 public sector, on the left hand side we have the public sector banks, and on the right hand side we have the private sector banks. If one compares the asset base, we see that SBI, the State Bank of India, look at the asset base, all numbers in $1 billion. You have 5.7 over there, 5.07 versus SDFC Bank, being 110. But however, one tends to compare the market cap that each of them enjoy. That tends to vary a lot. This also, if one wants to see, although we've not put it over here, but if the multiples, or in terms of what the investor is ready to pay, the top bank HDFC, trades at 4.5 times their book value, whereas if you talk about State Bank of India, it trades at 0.87 times their book value. So similarly, all across, there's rarely does one come across a public sector bank which enjoys a multiple greater than 1 in terms of its book, whereas almost all private sector banks, are trading above 1.5 times their book value, that being the least, and an average being above 3. each one of them, clearly showing the focus and the trend for more of growth, capital chasing equities in India as compared to value stocks in India. Talking about the key features as to how do we see the banking space growing in the country. We have the total lending has been growing at a compounded average growth rate of 10%, and the total deposits have increased by 17% in FY19. In terms of the ATM machines, which really was a revolution when they were introduced in terms of shortening queues in the banks in the early part of 2000s, currently has reached over 210,000 and supposed to double by end of the next calendar year. In terms of the rural penetration, 44 rural banks are in the country, and the Reserve Bank of India has allowed regional rural banks with a net worth of at least $15 million to launch internet banking facilities, and this has been promulgated and expedited with the coronavirus, with social distancing norms and people not entering most of the banks these days. If you try to see how has the credit growth been growing, it's around a 13% offtake between 16 to 20. The credit offtake has grown at 13.9%, and total credit has extended to about 1.9 trillion US dollars. According to the Reserve Bank of India, bank credit and deposits stood at 1.5 trillion and about 1.9 trillion respectively by around mid of this calendar year. If we talk about the asset base, we have been seeing a healthy growth in deposits as well. Bank accounts. There was a flagship product called the Pradhan Mantri Jan Dhan Yojana, which translates to in from colloquial language, it translates to Pradhan Mantri being the Prime Minister promulgating the opening of accounts for the people who do not have accounts, and the Jan Dhan account stood at more than 1.18 billion US dollars currently. As of June 20, the deposits of 11% was marginally lower than the growth rate of around 11%, 11.3%, same time last year. We also tend to see that the public sector accounts for almost around 66% of the total banking in the country when compared to the foreign and the private sector banks. We tend to see that adding a little bit more, the interest income of public banks has reached about 98 billion, and the public sector, as stated earlier, over 60% of the interest income accounted for in FY20. If one talks about the investment deposit ratio and loan to deposit ratio, we see an uptrend coming on over there as well. The private and foreign banks have posted higher returns on asset than nationalized and private public banks. This has prompted most of the foreign banks to start the operations in India, and we see that the credit deposit ratio also, on a similar fashion, being the highest in the private sector banks, which is driving this trend. One would try to speak about we having the annual growth coming of our low age of our population being at around 27, and the GDP versus population growth pushing this. But then one should not undermine the efforts that the government has been taking, and various improvements have been brought about in risk management practices. Also, a key thing to note is that from net interest incomes, a lot of deviation has been seen right now in other fee-based incomes in many of the banks. And not to undermine the impact of technological innovations, that have been brought about in the Indian banking space. There's a lot of focus on financial inclusion by the government from the Ministry of Finance. They have launched, financial inclusion index, and clearly shows their push towards the same. Demonetization, in FY16, where the majority of the legal tender was banned on November 8th, was a major movement. While there are many parties who are, divided on both sides as to who support or are against the demonetization event, but yet that did lead to a lot of financial inclusion, and a lot of the cash-based economy was challenged, if not stopped. And a lot of the SME sector, the churn that was seen on the ground, I myself was a part of helping structuring a lot of small SMEs who were trying to grapple with the changes of paying salaries, and because the legal tender was no more valid, and that brought about a great change in the way banking is done in the country. With wider acceptance of RTGS, NEFTs, and IMPS, RTGS being real-time gross settlements, the changes is of a large volume. Number of transactions through the IMPS, that is the immediate payment service, increased from 189 million in volume, which was in rupee terms around 1.8 trillion rupees in FY19. That's gone up right now. This number, as compared to what it was in FY16, is somewhere around double of that in FY16. Also, to prevent frauds, a greater drive of know your clientele, that is kind of a focus has started across the country. In terms of digital lending, has been growing pretty fast in the country as well. And around in the current year, we are estimating roughly around 150 billion US dollars being the digital lending. It's supposed to go to around 350 by, these are my personal estimates, around FY23. That's where we see this going, and it's going to be a major trend driver going ahead. In terms of rural India as well, we have around 600,000 village habitations, and about only 5% have commercial banking branches. So in that, the key thing to note over here is that 51% of nearly 8.93 million farm households do not have access to any credit from either institutional or non-institutional firms, and this is there's a change that mostly people are seeing currently. In terms of mobile banking is a very, very cost-effective methodology that is bringing about the change in the country. And like we said, a lot of strategies that have been adopted are the increased use of technology, cross-selling of various other products such as insurance, mutual funds, various other kind of loans such as auto loans, etc. Expanding overseas so as to have India has a great residential Indians, as we call them, NRIs. So a great inclusion of the NRIs in the country, and going ahead, and not to say the impact of the economic and demographic drivers in the country. India ranks among the top 7 countries economies with GDP of around 2.7 trillion in 2018. These numbers have of course changed currently. Support by the government, the infrastructure financing. We see in the interest of time, although I'd earlier thought of speaking a lot much more on all these fronts, but remain the key growth drivers in the country. One would like to see about as to what kind of the impact of the coronavirus would be. The government, the key thing to note is that they had given a 180-day moratorium on principal and interest payments, and that is likely to have an impact. Let's see, come January, and how do the banks have been debarred from bannering anybody with the name of a non-performing asset currently. Let's see how does the balance sheet get impacted. It's estimated roughly around 15 billion US dollars would be required to meet the 10% weightage for the tier 1 capital, and the amount could rise to about 58 billion, under the high stress situation being the worst case scenario. Come January, let's see how does this pan out. But nonetheless, as a participant of the capital markets, we tend to remain bullish. Well, in the interest of time, would be wrapping up. Sorry for my increased words per minute, but I hope I was able to introduce the sector and give a broad outline as to how I see this sector going ahead. Thank you.
Thank you, Mr. Bardwaj, for this general introduction of the Indian banking system. I have one general question. So we at least know or read from news that India has a very dynamic service export sector, right, from IT or financial services. So how does that affect the, so if a service export firm want to get credit, do they, which type of banks finance them? Or do you consider them as growth or value investing? And on your slide number 9, public sector assets were declining, and in another slide, for the fiscal year of 2020, credits were increasing, but deposits were decreasing. I think it was slide number 4. So was this increase in fiscal year 2020 due to COVID support measures? I think, can you come down, please? Not this one. Maybe next one, please. Next one. The 8, I guess. Can you go to 8? No, there was a slide. Yes, here you see that compared to fiscal year 2019, growth in credit in terms of US dollars seems to be higher. Like deposits are decreasing in 2020, but credits increasing. What does that mean? And in terms of a general question like growth or value stock investment, how do you assess the service export firms? Are they dynamic? Can they access finance? I would like to learn about that. Thank you.
Sure thing. The previous question that you spoke about, it was self-explanatory in terms of so in India, the financial year ranges from April to March, and the major part of the COVID-19 pandemic impacted us. So our Q4 is usually the Q1 globally. So calendar year Q1 is equal to our Q4, and there is where the impact of COVID-19 really hit us hard, and that is why we see that drop, in FY20. I think that explains it. And whereas credit requirement was still a requirement, many firms facing a lot of hurdles in terms of delayed payments, inventories being blocked, and money was needed, whereas the growth in deposits took a hit, and COVID-19 is the sole blame to be given on to. That's number one. Number two, in terms of the export-oriented industries that we have, not only service but even manufacturing, a lot of emerging manufacturing units, industries such as the chemicals. India is emerging to become a great exporter of organic chemicals globally. And then, so usually what happens is, to the extent of your exports, credit is easily available offshore. And there tends to be a dollar-based lending because it's cheaper, number one. And number two, there's a natural hedge because your income is dollar-based and tends to offset the currency fluctuations that could be expected. In terms of the general scenario that you have in the country, as long as you have firm orders, credit is really not a problem in terms of obtaining it, albeit at a higher cost, because Indian lending tends to be in that 8 to 9%, 8 to 10%, depending upon your rating, credit rating, corporate credit rating. Nonetheless, from abroad, it tends to be much cheaper. Although, as we speak today, certain PSUs have offered commercial paper as low as 3% currently, both from operating in the manufacturing as well as in the service sector. So yes, 2 points. Credit is not an issue, be it FCBs or local funding, and as well as they're on a downward trend. So yes, money is getting cheaper in the country. Thank you.
Thank you very much. So the next speaker is myself. Just one organizational detail in the program. In this special session, we have 5 presentations. The 4th one is mine, and the next one we will update the YouTube page after the end of the session. So I will be presenting, and then we will end the session, and then we will add video of the presentation to the YouTube session. So So if you don't have any questions or anything to add, I will start my presentation. So can you hear me, and can you see my slides? Can confirm? Okay, then I'm starting. So can you see the slides, right?
No, I can't.
Okay, so I will be talking about economic outlook and monetary policy before the global title of my talk is Change in Monetary Policy Making during the last decade. So there are 2 events, significant events: global financial crisis and the COVID-19 pandemic. I will reflect on the developments after these major events. So the outline of my talk will be: I will start with the economic outlook and monetary policy before the global financial crisis. Then I will move to after the global financial crisis. And in terms of COVID-19, I will talk about policy response and challenges ahead. So let's start with economic outlook and monetary policy before the global financial crisis. I have 2 slides here on 2 graphs. On the left, I have GDP growth in the pre-GFC period, and on the right, I have inflation. The blue ones are for advanced economies, and the orange ones are for emerging market and developing economies. Let's look at the left one, the GDP growth first. We see that before the global financial crisis, from beginning of early 1990s to the 2007, GDP growth was stable in advanced economies, around 3%. And after 2000, GDP growth accelerated in emerging market economies, reaching more than 8%, almost 9%. So stable and durable growth in advanced economies and high growth in emerging markets. And the reflection of this on the inflation was even brighter. In the early 90s, inflation reached 3-digit levels in emerging market economies, where you can see the orange line exceeding 120%, and it decreased to single-digit levels. For the advanced economies, inflation was around 2% up until 2006, and it was very stable. And the financial side of this was there was an increase in saving rates, mainly in emerging market economies after 2000. So emerging markets was growing faster, and they were saving a lot. This is so-called the saving glut issue, which was a factor in declining interest rates. And of course, if interest rates decrease, there will be asset side implication. On the right-hand side, we can see the house prices, right? It's an index, equal weighted, and it increases from starting from the 2001 up until 2006, a significant increase. Against this background, central banking before the global financial crisis, maybe we can outline 3 important principles. So price stability as the primary objective of central banks. What does it mean? We will see in the next session. Policy rate, or the real policy rate, is the main tool for monetary policy stance, and central banks try to communicate to anchor inflation expectations. So these were basically the main principles of central banking before the financial crisis. So let's see what happened after the global financial crisis. So we will look at the economic outlook and monetary policy after the global financial crisis. House prices were increasing up until the global financial crisis, but it didn't continue. On the left-hand side, the blue one is the house prices, and with the orange, I showed the level of the GFC peak. You can see that it reached to the GFC peak only in around 2017. So house price declined. Of course, this has implications for banking sector due to mortgages. And Levin and Haksar from IMF compiled data on banking crisis, number of banking crisis, sovereign crisis, and currency crisis around the globe. And you can see the uptick in the blue line in 2008. So house prices decline, asset prices decline, and several countries face banking crisis. What does it mean? financial stability matters as well. And in the case of a financial crisis or financial turmoil, central bankers can act quickly, and that's what happened. On the left-hand side, we see the policy rate of advanced economies and emerging market countries. You can see the blue line declined from around 4% interest rate to around 0%, for some countries even less. So central banks act quickly, but we have approached the so-called zero lower bound. On the right-hand side, we have the general government debt. The blue line, general government debt to GDP ratio of advanced countries, increased from around 70% to more than 100%. So monetary policy was supportive, but general government debt was increasing. That was partly due to financial policy, fiscal policy support, but also due to slowing down, say, economy or cleaning up the troubles brought by the global financial crisis. And what was the outcome? Let's now look at GDP growth and inflation again. On the left-hand side, we see that GDP growth, the blue line, declined in 2009. It wasn't negative for emerging market economies, but considering their long-term average, that was a very weak growth. GDP growth was stable for advanced economies around 2%, but for emerging markets, it declined to 4% from peak of 8%. But the key policy challenge came from the inflation side in advanced economies. On the right-hand side, the blue line, you can see approach zero, almost zero. So central bankers had to deal with risk of deflation or very low inflation, or hitting the target, inflation target from downwards, like not decreasing inflation, but increasing inflation. Before the COVID-19, you can see that inflation was stable in 2019, around 1.5% for advanced economies, and it was increasing for emerging markets. So what we learned from this period, Mishkin has a 2011 paper which nicely summarizes this lesson, so I quote him. First, financial sector developments have a far greater impact on economic activity than previously thought. Second, the macroeconomy is highly non-linear, so decreasing interest rate from 5 to 4% is not same as decreasing them from 1 to 0%. The zero lower bound is more problematic than we realized. Inflation is not increasing. The cost of cleaning up after financial crisis is very high. We see the increase in government debt. And more importantly, price and output stability do not ensure financial stability. So one lesson from global financial crisis was that it is not enough to target inflation, and keeping stable output growth and inflation growth will be enough for macroeconomic stability. And there is an example in Kuckerman's paper that, for example, in England, there was a special separate authority before the global financial crisis for financial regulation. So central banks start to focus just on the price stability. But after global financial crisis, accumulated risks in the financial markets could not be completely eliminated by inflation targeting and microprudential policies, even both inflation output gap were stabilized. So macroprudential policy design and the interaction between monetary policy and financial stability is important. So these are the lessons after the global financial crisis. Many countries, including Turkey, use several macroprudential tools. And while the scars of this global financial crisis era were alive, while many countries were dealing with maybe low inflation, high debt, or low growth, COVID-19 pandemics hit the world. So I will try to summarize policy responses, challenges ahead, and what may be a solution maybe. So in this graph, I show the share of countries with negative GDP growth from 1980 from the IMF. You can see that in 2009, the global financial crisis, less than half of the countries in the world has negative growth. Now, according to IMF, close to 90% of countries will have negative growth rates. This is an unprecedented shock. But central bankers had some experience from the global financial crisis era. So now, in this COVID era, as Mr. Bharadwaj noted, for example, in the Bank of India, the credits increase while deposits are stable because of the COVID support programs. You can see this on the left-hand side, Fed's total assets, and on the right-hand side, ECB's total assets. So in the QE1 to 3 era, on average per month, 45 billion USD dollars of asset increases, balance sheet increases. In the COVID, it was much higher and much faster. Similarly for EU, for ECB. So central banks reacted quickly and strongly. Of course, increasing the balance sheet was not the only channel. Central banks and financial policy took several measures, from rate cuts, bond purchases, additional liquidity measures, swap agreements, capital buffers, credit refinancing, and credit support programs, both in advanced economies and also in emerging countries. And there is some view that in the COVID-19, emerging market economy central banks could apply monetary policy like advanced economies. For many countries in emerging markets, purchase government bonds, similar to advanced central banks in response to COVID-19 crisis. So we have the experience of global financial crisis, and that helps somewhat in COVID-19, but also we have this macroeconomic stocks. So challenges in the post-COVID-19 era, we can name several. I list here 6 of them. So first, low interest rates for longer. If in advanced economies we have low interest rates for longer period, how will that impact reaching inflation targets? So recently, Fed changed strategy and said, like, Fed's average inflation targeting, how to reach inflation from bottom to how to increase inflation. And of course, effect and future of increased central bank balance sheets. In one day, say we want to roll back this monetary policy support, how will be that done, or how will that affect? And increasing indebtedness, not only for governments, but also for private sector. How will that affect the future of the economy? Of course, these are maybe financial issues, but we have also structural economic issues going on with the COVID. So first, one thing, we are now meeting with Zoom online, several countries, several presenters. So changing the use of technology and of course the future of the labor market. And finally, changes in the trade flows and structure of global value chains. All of these will have effect on macro balances in advanced economies and emerging markets. So as economists, as central banks, we will be thinking about these issues. And while advanced economies applied a huge quantitative easing or increase in balance sheet, we see that this time, due to uncertainty, increased uncertainty, capital flow outflows are much severe compared to global financial crisis. During the global financial crisis, they start to recover after 28 weeks. Currently, after around 40 weeks, they didn't recover. So this poses a problem on exchange rates, on financing the growth, etc. And regarding, for example, low interest rate for a long time, BIS has several papers on this issue. For emerging markets and advanced economies, these may have different effects, from like weak balance sheets, freeze incentive to reduce excess capacity in the financial sector, and so on. And for emerging markets, capital flow channel is important. So after global financial crisis, we have quantitative easing, which led to surging capital flows, rapid credit expansion, and real exchange rate appreciation. And these amplify macro financial fluctuations. And solution is not just with single rate monetary policy. Consider capital inflows significantly. You increase domestic interest rate, it causes appreciation and wider current account deficit, which lead to sudden stop risk increase. So in summary, there are multiple objectives like financial and price stability and so on. So multiple instruments are needed. In the latest inflation report, Central Bank of Turkey published 2 boxes, and I will finish with 2 charts from there. For one thing, this is the monetary policy transmission mechanism, and in several things may interfere or may be friction to the monetary transmission mechanism. So in one thing, if exchange rate depreciates, that will make exports cheaper for foreign countries and imports expensive for domestic people. So there will be expenditure switching effect. But if there are import input intensity is high or dominant currency pricing, which means that if you are invoicing your exports in dollars, then that will reduce that channel. All balance sheet channels, which means if your firms or households in some cases have debt in foreign currency, that will affect that channel of the balance sheet, and exchange rate pass-through may be high to inflation. So while we have this classical monetary transmission mechanism, due to several factors like import input intensity, dominant currency pricing, foreign currency indebtedness, and exchange rate policy, just changing interest rates may not be enough. So in the another box, we discussed the integrated policy framework. Consider the case of rising risk, global risk appetite that will cause appreciation in domestic currency, increase in FX debt, rapid increase in loans, expansion in economic activity, and inflation pressure. And monetary policy should, maybe in that case, tightening monetary policy, FX reserve accumulation, and several other topics. So monetary policy, macroprudential policy, capital flow management, exchange rate policy, and fiscal policy, maybe in a coordinated manner, can address these challenges. In other words, after global financial crisis, financial stability and macroprudential policies are used extensively in the future with these challenges ahead. Maybe we will see more of this integrated policy framework. So that will be the end of my talk, and Mr. Siviero started to talk with disclaimers, so I will end. Of course, the usual disclaimer applies. These are my views, not the central bank's. With this, if you do not have any question, okay, we have one question.
Maybe
we have one question. Let me see. About the auditing. Is the question about auditing of the central banks, Mr. Bardwash? Can you make the question? Maybe we can talk it in the later. So Mr. Siviero have a question, I guess. Please, the floor is yours.
so. Well, thanks a lot, Mahmoud, for your very rich presentation and very very interesting. Well, of course, we are both central bankers, so I understand very well that whatever you say is your own personal opinion. But you didn't say much about, or it didn't transpire so much about effectiveness and risk. Whether you think these measures have been effective, and you may know that, especially in the euro area, there was a lot of talking about risks of QE, that in the long run QE would be possibly a disaster, etc. We haven't seen anything so far, but I would like to hear your own personal opinion on this point.
So that's a very to the point question. One of my points in the slides, like challenges ahead, I try to highlight that all this central bank balance sheet expansion, one day we may have to normalize the monetary policy support, and that's the question. You are right. Like in that case, the macro balances, the inflation, there are risks. But I think there are research that this quantitative easing had at least, while the inflation is very low, around 0.5% on average, it didn't go deflation. In that respect, you may think that it helped. Personally, not the central bank's view, of course. Personally, am I concerned as an economist the future of the quantitative easing? I'm thinking. I'm giving some thought about how to shrink this central bank balance sheets, of course. So there are risks, but given the current challenges, I think they helped. Any other question? So I think there are no further questions. So this will be end of our session, this special session on banking systems. I thank all our participants, Mr. Siviero, about this climate change. It was so it's an emerging issue, and there are some central banks which reflect on this. There are talks. I think there was a recent chapter in IMF, if I'm not mistaken, about the effects of climate change. So it was nice and very informative to hear about that. About the central bank, about the banking system in Argentina, I learned a lot about what's happening, why it's happening. In terms of growth and value investing in India, it was very both micro and in terms of micro banking data and macroeconomic data. And I tried to summarize the challenges as central bankers we face after global financial crisis and the COVID-19 pandemic. Thank you all for joining and listening. And Sema Hocam, do you have anything to add before we finish?
Thank you for your all.
Thank you. So this will be the end of
the sessions.
So this is the end of session. You can find this on YouTube. Thank you. Thank you very much to all participants again.
Thank you. Thanks a lot.